So without delay, we'll start. So we are in risk measurement where we have completed yesterday sensitivity. Now the second one is volatility. Sensitivity means how sensitive the portfolio or the security is according to the change in any of the parameter, any of the single market parameter. Okay. That is how sensitive means whether it is the value or say price is going up or down, that is called sensitivity. Now volatility means it is something similar to sensitivity, but it is little different. It is about whether the price or value is stable or unstable. That is measured by volatility. So here in volatility, we have to see whether the change of any random variable makes it stable or unstable of any security. Okay, so volatility is about the stability or instability of any random variable. Any random variable, however it is changing, how stable it is there in the market or it becomes unstable. That is actually calculated through volatility. So that is called volatility. So which are the random variables? These are the random variables which we have to see whether they are stable or unstable. So earnings, normally we are into risk management. First thing is earnings, income, whether income is coming up or going down. Then mark to market values, means the gain or loss, whatever is there at the end of the day, netting of all the gains and losses together. So what is the ultimate value, how it is performing in a day? Then market value of the security and definitely loss due to default. If there is a loss due to default by the counterparty, then how much that is stable or unstable, that is the main feature of volatility. So in volatility, how this is measured? Volatility is measured or captured as the standard deviation. So we have to use the formula of standard deviation of these values. Whatever the values we are taking, any of the random variables we are taking, so we have to take the standard deviation of that, where the standard deviation is the square root of the variance of the random variable. So standard deviation equal to the square root of the variance, of any random variable. How this is calculated, I just will explain it in the next slide so that it will be easy. So volatility measurement is done through standard deviation procedure. Okay. So this is the way how volatility is going to measure. Then we will see how the BPV is measured, then how the VAR is measured. These are the two important tools where VAR is the main and very widely used and popular tool in measuring the risk as far as the market risk is concerned. Okay. Now, suppose, for example, I'm taking how the standard deviation will be calculated. Suppose a simple share I have taken. Suppose a company, X company is there, X company's share has been bought by me or the bank. Bank is holding this share. So I have taken the share price of 5 months. So 1, 2, 3, 4, 5 months share price I have taken. Average share price in that month I have taken. So share price of March was 100 rupees, April was 110, May 90, June 120, July 150. That means it is changing. Okay. Now we have to find out what is the standard deviation root of that through the standard deviation formula. We have to find out what is the volatility. So share price I have taken. So just here I have taken 5 months data. Okay. Then of this total thing, I have to find what is the mean. Mean means you add up the total of this 5 and divide it by 5. So if you add up this and divide it by 5, it comes to 114. So mean is the average of these 5 data data sample I have taken. So add these 5 share prices, divide it by 5, so you get 114. So mean is the, or mean or average is the 114. Okay. Now next column is to find the deviation of each share price with the mean. What is the deviation? We'll see. So each share price minus mean. So 100 minus 114. So it becomes minus 14. 110 minus 114, it becomes minus 04. Like this, it is minus 24. Next one is plus 6. Next one is 36. Okay. Then next column we have to do, what is the square of the deviation? Means this deviation, just square of this deviation. So deviation square, d square. D square is minus 14 square is 196. 4 square is 16, 24 square is 576, 6 square is 36, and 36 square is 1296. Then we have to add up these squares of deviation. Square of deviation, we add it up. So it comes to 2120. Okay, now this 2120 is nothing but this is called the variance. This is the variance. Now we have to take the average of this variance. First, we have to take the sum of the variance. Then we have to take the average variance. Average of variance, always remember, in case of some such sample of say 5 or 6 or small data, for getting the accurate answer, we have to use the formula. Number of data are 5 actually. So instead of dividing it by 5, we have to divide it by 5 minus 1. So that's why it is called n minus 1. So 2120 divided by n minus 1. So that becomes 2120 divided by 4. So that equal to 530. 530. So this is the average sum of square root of the deviation 530. Now the standard deviation equal to square root of 530. So that becomes our 23.02. Only thing where here you have to remember that while taking the square root of the sum of deviation, you have to remember that while taking the average, you have to always use that n minus 1, not n. Here we have used n, because this total divided 5 we have done to get the average or mean. But here we have to use n minus 1. Okay, so
sir, is there any logic to do n minus 1?
You do it. Don't ask me the logic. You can Google it. You will find it. I have told you that for small samples, always n minus 1 will give the accurate result. If bigger samples are there, suppose you are taking a population, so 1 lakh or crores of people you are taking, in that case n is taken. Some smaller items you have to take n minus 1 to get the accurate result. If you do not take n minus 1, your answer will be wrong. Okay.
Thank you, sir.
So
Thank you.
Always remember n minus 1 has to be taken for small samples. Okay. Now,
Thank you, sir. Thank you.
so now this standard deviation is 2302. So this is what we want to arrive at. So what does this 2302 means? Okay. So it indicates this 23, or say we can say this is 23. Suppose 23.02 is valid, we round it up 23. This number indicates that the share price of this company has a volatility of around 30 on both the sides of the mean price of 114. That means 114 was the mean price. So share price in these 5 months, approximately it has gone down by 23 rupees this side. It has gone up by 23 rupees this side. So this is the volatility boundary. Volatility boundary is 23. It might not be the exact 23 for all the getting 90 result. 90 was the least and 150 was the highest. So exactly 23 it might not be there, but to get the approximate range, we can say that 23 is the amount where the share price has deviated towards the lower end and also gone up by 23 only. So from the month of March to July. So this is basically, we can call that 23 is the monthly volatility of this particular share price for these 5 months. Is it clear?
Yes, sir. Yes, sir.
Okay, clear? So you can do it if the questions is asked, such type of thing, the prices will be given, security value will be given. So you have to calculate the standard deviation by this thing. Okay, standard deviation calculation, share price, they find the mean, then find the deviation, square the deviation, sum it, then find the average by dividing it by n-1, then square it, calculate the square root of that variance. So that becomes your volatility per month. Okay, so this is the example of volatility.
Sir, one question is, sir, daily volatility of a stock is 0.5%. What is its 10-day volatility?
Okay, I'll explain that. So you are jumping into 3-4 steps ahead. I have not explained that thing. You are jumping into 2 or 3 steps ahead. Gradually,
Okay, sir.
I'll solve the problem. Okay. So now, sometimes, as somebody has asked, I'll just explain. Sometimes questions are asked. So this 23 was monthly volatility. So sometimes question will be asked, if the monthly volatility is 23, find the daily volatility. Sometimes question will ask, convert any volatility into daily volatility or weekly volatility or monthly volatility or the reverse way or any number of days. Suppose 23 is the volatility for 45 days. 45 days volatility is say 23. Find the daily volatility. How to do that? So you have to always remember, some question might be asked for that. So you have to remember, in such volatility calculation, we have to use the square root of the time rate. So square root of the time rate has to be used. Okay, what is that? I use. Suppose the volatility of a portfolio to be calculated is for a time period T. So time period is T. Suppose we want to calculate the volatility for a time period of T, where the daily volatility, suppose daily volatility is given as D. So daily volatility equal to D. Suppose it is D. And you are asked to convert it to certain time. So that is T. In such case, the volatility for that particular time period would be D multiplied by square root of T. Write it down. Volatility will be daily volatility multiplied by square root of the T, means what is asked for. For example, if the daily volatility of any security or stock is say 1.5. So this is the daily volatility, 1.5. Find out monthly volatility. Monthly volatility will be how much? So D, we know D is 1.5. So 1.5 into monthly means 30 days. So square root of 30. So what is the answer? 1.5 into square root of 30 is 5.48. So it comes to 8.22. Or the reverse way it can be done. So if you know this formula, then you can do it the other way also. It is possible to do. Okay. Is it clear? So volatility questions, if comes like this, you can do it. There is no problem.
Sir, what is daily volatility?
What is daily volatility means? In one day, how much it will be volatile? If the monthly volatility we have got 30, this is for 30 days. This monthly volatility is 30 days for 23. So find out the daily volatility. How you will find?
Okay, sir. Okay.
Okay, you got it. So
Yes, sir.
you can see I have taken this monthly 5 months. I have taken an earlier example. Suppose in a month 30 days I have taken, so I can find out a daily volatility or not. Same way, the earlier table I have showed you, in that table, this table I have taken 5 different months. Suppose I will take 1 month where 30 days will be there. So 30 days share price I will take, the mean take, everything I will do. Then whatever the standard deviation I will find out, that is for daily volatility. So that will give me a daily volatility within a period of 30 days I have calculated. Okay? Okay. Now we will come to the next one, which is called basis point value. Another calculation of volatility, which is called basis point. So basis point value means what? Basis point value means BPV is the method to measure the interest rate risk, because here we are all whatever sensitivity or volatility you are doing, out of this BPV directly measures the interest rate risk. Means for change of interest rate for a certain percentage of interest rate, what is the change in the price of the bond or security? That is can be measured through BPV. Okay, now we'll see. Suppose BPV means BPV is the change in value of an investment due to 1 basis point, or this is 1 basis point, BPS. So we have to calculate what is the change for 1 BPS, or 1 BPS equal to 1 divided by 100%. So we can say 0.01%. So for a 0.01% change in the market yield, what is the value of investment change? That is called BPV. So if we know that for 1% change, market value changes by say 6%, say 60 rupees. 60 rupees. So BPV is how much? We have to calculate for 0.01% how much it will be changed. So simply we have to divide by 100, 60 divided by 100, so it will be 0.6. So BPV is the change in market value of investment due to 1 basis point change in the market rate or market yield.
Again, sir, please, again, show calculations.
Can you read this? You read this line. You read this sentence. Read it loudly.
BPV is the change in the value of investment due to 1 basis point, that is 0.01% change in the market.
So if the market rate or market yield changes by 0.1%, what is the change in the value of investment? Suppose investment value was 250 rupees and the market rate was 4%. Now market rate changed to say 4.5%. And since it has changed to 4.5%, it has gone up. So market value has changed to say 225. So now you have to calculate what is the BPV. Can you calculate as per this? What is the BPV for this change?
Sir, multiply.
Tell me what is the change in the market yield here?
25 rupees.
Change in the market yield.
0.05.
0.5. It is not 0.5. 0.5%. For 0.5%, what is the change in the value of the investment? 25. So BPV equal to, we have to find out 0.1%. So 25 divided by 0.5 multiplied by 0.1. Yes or no?
Yes, sir.
So simple thing.
0.01.
Bas, that's all. That is the basis thing of basis point value. Okay. So it tells us, the BPV tells us how much money your position will gain or lose for a change of 0.1% in the market yield. If the market yield or market rate changes by 0.01%, whether you are going to gain or lose. So simply, if the market rate goes up by 0.1%, whether you are going to lose or gain, lose, because market yield goes up, you are going to lose. Market yield comes down, you will gain. Simple, same theory applicable. Okay, so BPB will tell us how much money your position of the investment are going to gain or lose for a one basis point movement in the yield. So this is what the BPB does. So that means if a bond has got higher BPV, then you should remember that the bond has higher risk in it. Can you please mute your mics, please? If you are not asking the question, mute your mics. Background sounds are coming. So higher the BPV of a bond, higher is the risk associated with that bond. This is the rule you should remember. Higher BPV means it has got higher risk. Lower the BPV, lower risk. Okay, now we'll see, for example, suppose a 5-year 6% semi-annual bond at market yield of 8% has a price of 92, which increases to 92.10 when the yield becomes 7.95. So find out what is the BPP of this one. So market yield was 8%, which has come down to 7.95%. At 8% market rate, price was 92. Since it has come down, definitely the market price will be going up. So it has become 92.10. So calculate the BPV.
0.02. 0.02.
What is that? 0.02 is what? 0.02 is correct. 0.02 paisa. Okay. So rupees 0.02 or 2 paisa. Simple thing. That means for 1 basis point fall in the market rate, the market price changes by 10 paisa. So for this 0.05 changes by 10 paisa. So for 0.01, how much it will change? So it will change by 0.2 paisa. Okay.
And it is
clear?
BPV is in terms of what, sir? Time or percentage?
Here, what is written here?
Gain and loss.
So change in the value of investment is always in the currency, right?
Right, sir.
Here it is written BPB is the change in the value of investment. Value of investment is always in currency, whether it's rupee, dollar, whatever it may be. It is in currency. Okay. So now suppose this is the question I have given. Suppose I have a portfolio of say 1 crore rupees of this bond. I have got 1 crore rupees. 1 crore rupees of this portfolio. So what will be my loss or gain according to this? Your BPV 0.02.
2,000 rupees, sir.
Very good. Excellent. So I will be losing or profit it will be?
Profit.
It will be profit. Simple. Interest has come down. Interest has come down means value will be increasing. So I will gain 2,000 rupees. Okay, because this is 0.02 is we have taken that this is for 100 rupees. So for 100 rupees, 0.02 is the BPV. So 1 crore rupees, how much it will be? So it will be 2,000 rupees. So we can say that BPV of this bond is 2,000 rupees per 1 crore face value or 2 paisa for 100 rupees face value. Okay, now suppose another question I'll put here related to this. we can calculate easily the profit or loss for a given change in the yield also. Okay, so suppose according to this, I'll just erase this one. So we know that BPV is this BPV is 0.02 rupees for 100 rupees face value. This is the BPV we have arrived at. Now, from this we can calculate easily what will be the profit or loss for further change in the yield. Suppose for same question, if the yield of a bond, we can say that yield of the bond is say 0.02 with BPV of 0.02 for 100 rupees. Suppose further the market rate declines by 8 basis point. So this is the BPV, we got it. Now market is still declining the rate by 8 BPS. Then what will be the result? First, let me know whether it will be a profit or it will be a loss.
Profit.
So it will be a profit. Definitely it will be a profit. How much profit it will be?
0.0016.
Simply this is the result. Or if I will give that, suppose 1 lakh portfolio was there where my BP was 2000. Suppose the market rate goes up by 12 basis point. So what will be my profit or loss? So definitely goes up here. So there will be a loss. Loss by how much?
24,000.
24,000. So this way we can easily calculate. So BPV is there. So if BPV of bond is given, you can calculate when there is a further decline or rising of the yield rate in future, how much you are going to lose or gain. Okay? Is it clear? Another thing, remember, BPV of any bond will always change. It will change. BPV of the bond will change with the remaining maturity. Remaining maturity, whenever the maturity period comes closer, the BPV will be always changing. So BPV changes with the remaining maturity of the period of the investment. Suppose if a bond is, suppose this bond is 5 years maturity and the present BPV is 2000. Then as the maturity progresses, say after 6 months you calculate, BPV will be declining. So as it closes nears towards the maturity, BPV will be declining further, and at the time of maturity, on the day of maturity, BPV equal to 0. BPV will be 0. So BPV we have understood, there is no problem. If BPV any question comes, you can do it.
Sir, please show the formula of BPV, sir.
What is the formula again? BPV, whatever the 0.01 is a formula. You have to calculate what is the change in the market value for 0.01%. That is 1 basis point. You have to calculate for 1 basis point. That is the formula of BPV. If there is a change, here the question is given. So price was 92, it has come to 92.10. When the market rate was 8 and 7.95, calculate BPV. So for 0.05, what is the change? X was the change. So for 0.01, what will be the change? That is the BPV. What more formula you want?
Okay, sir.
Okay. Now next thing is VAR. This is one of the most popular and used by throughout the world to manage the market risk. So while managing the market risk, VAR is used very, very popularly, very widely. So VAR means value at risk. what is the value at risk? When the maximum risk happens, what will be the value of our portfolio or security? So we can calculate how much we are going to lose. So basically, VAR will give us approximately a figure that how much maximum we can lose. How much maximum we can lose. So that is given where this how much maximum we can lose given this amount will be say this will be in the amount that amount subject to 2-3 parameters. Subject to 2-3 parameters means always there will be a confidence level, there will be a time horizon, because you cannot say that how much we can lose within certain time period. So in a period of 1 month or 3 months or 6 months or 1 year or 1 week, you have to define that period. Within this period, this amount might be our maximum loss. And there will be a confidence level. Confidence level means when we calculate this is a statistical method. So confidence level. So always the VAR is given with a time period. Say, I can say that my loss can be 5 lakh. Maximum loss can be 5 lakh within a period of 6 months with a confidence level of say 90%. So that means what? This is the amount of loss. This is the first one. So this third one is amount of maximum loss within a time period 6 months. 90% is the confidence level. That means what? In 6 month period, I am confident that 90% of these days, 90%, 6 months means say 180 days. Out of 180 days, 90% of the days my loss will not exceed 5 lakh. It will be within 5 lakh. But rest 10% of the days, my loss may go beyond 5 lakh, more than 5 lakh. So that is the VAR. This is the VAR. So confidence level means it is within the limit of loss. When it is going beyond this, then we call it the value at risk. So that 10% days, my loss might exceed 5 lakh. So 10% of 180 days means out of 180 days, only 18 days, my loss may go more than 5 lakh. The rest of the days means 162 days, that is 90% days, my loss will be less than 5 lakh. So that is what the VAR prediction is. Any question?
But it is sure that they are very lost. Either it is greater than 5 lakh or less than 5 lakh. It is sure that loss will be.
See, all these are prediction. We may lose. How much maximum we can lose? We are going to lose. I am not written here. We can lose. There might be a profit also. No? So you do not know. We are calculating all the things because if we lose, we have to be prepared to calculate the capital and keep it. If we are not going to lose, then fine. No? So all the risk management, whatever you are calculating, there is always a may. We may lose. It is not guaranteed that you are going to lose. There is a possibility of loss. Potential loss is there. If your luck is good and you are doing risk management properly, you might not lose. You may gain. So we should be prepared when we are going to lose. So the question, that's why I have written how much maximum we can lose. I have not said that how much maximum we are going to lose. It is not guaranteed that you are going to lose. We are preparing ourselves. If that will be the loss, then we should be ready with that amount of capital we need for that to cover that loss. Okay. So
this VAR is only for calculating market risk.
Yes, yes. All the things we are doing, entire thing for market risk, from sensitivity, volatility, or market risk only. Because I have told you clearly the first, before going into sensitivity, that in case of loan or deposit, simply the interest rate gap will give us the amount of loss or gain. If you know the interest rate difference, we can calculate. So there is no calculation of anything. This is a simple way to calculate. But for investment portfolio, there is no such thing particularly. So interest might go up, market rate might go up many times in a day. So you cannot calculate accurately for that day. So such tools are used to calculate sensitivity, volatility, and so more other things are also there. Okay, is it clear? So always VAR will have a amount, that is the VAR amount, maximum loss we can have within a time period or time horizon. This is called time horizon. So always there will be a time horizon, 1 year, 6 months, 3 months, 15 days, 45 days, what you say, and there will be a confidence level. Confidence level means, you always remember, whatever the confidence level is given, that means that is not the loss. That will be within the limit. But rest amount of, suppose, say 99% confidence level. That means what? Only 1% of 180 days, the loss might go beyond 5 lakh. 99% days, it will be within 5 lakh. Okay? Is it clear? So VAR describes how much we can lose in a portfolio. That is, what is the loss potential. So VAR will have time horizon, confidence level, and maximum loss potential. That already I explained. So can you calculate this one? A bank having a 1 day VAR of 10 crore with 99% confidence. Sorry, this is an example. I'll give a problem. So here it is said that 1 day VAR of 10 crore with 99% confidence interval or confidence level means that there is only 1 day in 100 days. Or we can calculate as a year 2.5 days per year based on 250 working days in a year. Always remember another thing, in case of VAR calculation, a year is taken as a 250 days. It is not 365 days, because Saturday, Sunday are not taken as working day for a year. So worldwide, the concept of VAR is for 1 year, it is 250 days only. Okay, so we can say that if 99 confidence level means in a year, suppose 99% means 1 day in 100 days. So if a year has 250 days, that means only 2.5 days, or we can convert it to 3 days. So 3 days, the daily loss will be exceeding 10 crore under normal trading condition. So again, there is a condition is subject to another. Remember, always remember this normal trading condition. VAR works accurately if the market behaves in the normal trading conditions. If the market is totally erratic, VAR will not give you the accurate result. VAR will be not giving you accurate result. So VAR calculation or VAR prediction will be accurate under normal trading condition. Okay. So now question, you can do this question. 1 day VAR of a portfolio of 5 lakh with 95% confidence level in a period of 6 months, how many times the loss of the portfolio may exceed 5 lakh? Can you calculate and tell me?
Point 25, 7 days.
7 days.
7 days?
Yes, sir.
Okay. What is it coming in fractions?
Yes,
6.25.
Pardon?
6.25.
6.25. So we can take 6 days. Since it is less than 5, so round it up to 6 days, lesser one. If it is 6.5 or more, you take 7 days. If it is less than 6.5, you take 6 days. Okay.
6 days.
Okay. So is it okay for everybody how it is arrived?
Yes, sir.
Sir.
So simply
Sir, again, sir.
simply this
Sir, can you explain again?
Again, sir.
again means if you have understood this, why you want again here? Here simple thing, 95% confidence level given. So our loss will be 5%, which will be exceeding 5 lakh. 5% of the days. So it is asking in a period of 6 months. So in a period of 6 months means if a year is 250 days, so 6 months will have
125 days.
125 days into 5%, how much?
6 days. 6.25.
So we can take it 6 days. Okay?
Yes, sir.
Okay. Now you do this one. Read the question carefully and do it.
Four days, sir.
7.5 days.
7.5 days.
7.5, sir. 1.5, sir. 8 days.
8 days.
Always round it up, eh? Round it up. Always days. 7.5. It cannot be either.
8 days, sir.
8 days is the correct answer. Okay.
Yes, sir.
1 mark confirmed.
Now carefully read this again. Do it.
$25 days.
Anybody else?
25 days, sir.
Anybody else?
23 days.
25 days, sir.
23 days, sir.
25 days, sir.
23 days.
225 days, sir. May not
23
exceed
days.
Yes, sir. Yes, sir.
25 days.
Only 23 days.
225 days.
This is the correct. That's why I told you read the question carefully and do it.
May not
Yeah,
exceed is there, sir. That's why 225 days.
May not exceed means 90%. Okay, so read the question clearly, very carefully. You have to read. May exceed means we are 10. We'll take here 10%. May not exceed means 90% you have to take. So normally we make mistake by not reading the question properly. So always read the question slowly. It will be easy. So 225 will be the correct answer for this.
Sir,
Okay.
how it is calculated, sir?
How it is?
It is calculated to 25 days, sir. How, sir? 25.
How? 90% of 250, how much? 90% of 250 is how much?
Okay, it is coming 25.
25.
90% of 250 is 25.
225, sir.
225. 225.
So that's why 225 is the answer. Is it clear? Have you understood this or not? The person who asked me this question.
Yes, sir.
No, somebody asked now how it is 225. Whether you got it right now. Is it clear to all of you or not?
Yes, sir.
Yes, sir.
A little bit confused.
Clear, sir. Clear, sir.
Sir,
Yes, sir. Clear, sir.
Where is the confusion? I don't understand. I have explained to you, if confidence level is given as 99%, that means 99% of the days we are not going to lose more than what is the VAR is. So 1% the days we can exceed, the portfolio may exceed the VAR. So here it is, question is, 90% confidence level, question is asking how many days we are not going to exceed 5 lakh. That means how many, whether it will be 10% or 9%, 90%. How many days our
90%.
loss? 90%. So 90% we will calculate. So 90% of 250 is 225. Earlier question was C. Earlier question was may exceed. May exceed means we have to take the 3% one. So 97% it is not going to exceed, 3% going to exceed. So that is the difference between these two questions. Clear? Now we
Yes,
move
sir.
to
Always we consider 250 days only, sir, in a year.
you are asking any question?
Yes,
Are you
sir.
asking? What is the question?
Only for what?
What is the question?
Sir, always we assume 250 days in a year, sir, or otherwise, in a question there may be a difference, sir.
I have told you for VAR calculation, categorically I told you for VAR calculation, 1 year has only 250 working days. That's all. When you are doing VAR calculation, if 1 year is given, always you have to take 250 days. That's all. Okay? I have explained that. Then what is your question? Is there any question, further question is there on this or?
For 1 month, week, sir?
1 month will not be asked. 1 month will not be asked. 1 month question will come in the volatility.
Sir, we need some practice question.
First you complete the module, then you practice question. Module is totally not completed. We have completed only 3 years. This is the 4th class.
Okay, sir.
First we complete. I will give you questions. If so, questions are available in the website also. IBS Vigyan also. That is there. 300 questions, 400 questions are there. Numericals are there. You can do a lot of time. First, you try to understand the concept. Then you can go for solving the problems. Okay. That is enough time. First, we should complete the module. Then we'll go for other things. So third thing is risk pricing. So according to risk, pricing of anything, pricing means what is the loan interest to be charged. Interest on any particular loan we are going to charge. So that is basically the main concept of risk pricing. So how the loan interest is decided, can somebody tell me? How the loan interest is decided? How you are arriving at that? Yeah, tell me.
Collateral coverage.
Risk weight rating.
Depending on the risk on the loan, sir.
Rating also.
My question was. My question is.
Based on the economy.
MCLR and source of funds. MCLR.
How that is the interest rate. How MCLR is calculated? How you arrive at your MCLR? Suppose your MCLR is 9%. How you arrive at 9%?
Based on the inflation.
Cost of deposits.
Interest rate is arrived on the base price plus risk
Transfer price mechanism.
plus risk spread and term premium.
Assets and liabilities come. Cost of deposits.
Demand and supply, sir.
Cost of deposits.
Based on credit rating.
No, sir.
Based on the GDP.
Where from this are coming? You are just blindly throwing whatever is coming to your mind, you are putting in the darkness. Anyway, okay. So I will explain what are the factors are taken into arriving at the MCLR or rate of interest to be charged for any loan. Okay, so you should remember those things. That is very important because
operational risk, all these risks, basing on risk rating, we are deciding the interest rate of a particular loan.
okay, I got it. I will explain. Then you can understand what are the factors. Okay, so out of those factors, risk is one of the factors. Out of 7 or 8 factors, one factor is risk. So that is called risk pricing. One of the factor is risk. Why this pricing or rate of interest to be charged in the loan account to be decided? Because we are doing all this risk management for what? What is the main purpose of doing risk management? What is the main goal? Capital.
Mitigate the risk was loss safeguard.
Okay. So basically, what is the to definitely you are to prevent the losses, but side by side, main work is to maintain capital. We do not know whether that will be a loss tomorrow. So we have to reduce the capital. So basic thing of risk management is maintenance of the capital or maintaining the capital. Because for one thing, capital is the basic or fundamental thing for any kind of business. Second thing is, it is a regulatory requirement. RBI says that you have to maintain capital. So you cannot say that I don't want to maintain capital. RBI says means you have to obey. And third thing is, maintenance of the capital is not free of cost. Capital comes with a cost. There is a cost to the capital. So what is this cost? Cost to the capital is basically when you are arranging for capital. If it is your own capital, then there is no problem. But definitely you have asked the public to invest in your capital. So most of the banks, we have issued our shares to the public. Public has invested. So they are the shareholders. So one of the cost is you have to pay them the dividend. Dividend has to be paid to the shareholders or investors against their investment. Second thing is, the source of capital is what? To raise the capital. Once you have raised the public issue, that is fine. Later on, when the business is going on continuously for years together, where from capital is coming? How you are strengthening your capital?
Capital market.
Profit. It is from the profit. So where from you get profit? Bank's main profit comes from which area?
Interest income.
Basically, we can say loans and advances, and definitely some kind of investment or treasury. These are the area from where the profit comes from. So these are the two costs involved in maintaining the capital, apart from the 3 things I have given you. This is the basic thing in a business to maintain the capital. It is a regulatory requirement. Third is, capital has a cost. So to compensate the cost, to how you are going to give the dividend, how you have to charge. So all this cost will come from making profit only. So you will make the profit only when you are managing your interest rates, charge on the loans. Okay, so that for each banking transaction we do should be able to generate necessary amount of surplus to meet the cost of capital. Hence, it is always said that the pricing of each transaction has to be there in the banking. You have to price it. Okay, so this is the risk pricing. Now is one of the factor of arriving at the rate of interest to be charged in a loan is risk pricing. So we'll see what are the things. What are the things? So basically, I told you this thing. Now we'll see. These are the factors which are deciding the rate of interest for any loan. First is cost of deployable funds. Cost of deployed fund means this is the rate of interest, average rate of interest or rate of interest paid to the depositors. You are getting fund from depositors. So what is the amount of depositor you have paid as interest? That is one factor. So total interest paid for a year, say this much interest we have paid to the depositor. So that you have to recover from the interest you are charging. Second is operating expenses. The salary we receive as a employee, the rent, taxes, building expenses, or whatever the operating expenses, that has to be also added. Third thing is loss probability, means this is the risk factor. Due to loss in loan losses or investment losses, if loan becomes NPA or investment, we lose many things. So those are the factors has to be added into the pricing. Then maintenance of the capital, means dividend has to be paid. So after you calculate all four, there is another thing is there also. So sixth is, now RBI is told that whenever this repo is changing, earlier repo was not related to our pricing, but now RBI told that when repo changes, whether repo is increase or decrease, the factor of that increase or decrease has to be also included in the calculation of your rate of interest. Then after doing all these things, bank have to maintain a profit margin also, because 1, 2, 3, 4, and 6, if you take into consideration all the factors taken, you reach at a break even. That is your break even. So after break even, we have to show our profit also. So we can add the profit margin. So these are the different factors which are taken into consideration to arrive at the rate of interest to be charged for our loans and advances. Where is the GDP coming? Somebody told that GDP. Where GDP is related to these things? Anyway, these are the things, and loss probability is one of the factor for risk pricing, because we are taking risk into consideration. So credit risk or any market risk is happening, that is called loss probability. So that's why risk pricing has to be done.
So what is capital charge?
Capital charge means how much capital is required to be calculated. That is called capital charge calculation. For each of the thing, each of the loan or investment you are doing or any operational risk you are doing, how much capital has to be calculated for a particular loan, how much capital to be calculated for a particular type of investment. So that is called capital charge. What is the requirement of capital is called capital charge. Amount of capital needed or amount of capital required to be maintained is called capital charge. Okay?
Sir.
Any question on this? Risk pricing?
Sir, profit
margin, sir.
Profit margin, sir.
You are doing a business. If you are doing a business, I have told you that all this 1, 2, 3, 4, and 6, I have told you repo. If you take all the factors together without taking profit margin, then your rate of interest, whatever you will charge, that will be a break even. Means you will not show any profit or any loss. So you want to show that to public that you are adding, you are having some profit or not. Suppose you have bought, suppose you are selling vegetables in the market. Selling vegetables in the market. Okay, so you have bought the vegetables, say rupees 15 rupees per kilo. 15 rupees per kilo. Now you have carried that to transport, so that cost was 5 rupees. Now it is 20 rupees. So will you sell the vegetable at 20 rupees? Are you going to sell at 20 rupees?
No, sir.
Then how much you are going to sell?
25.
More than 20.
More than 20, na? So why more than 20?
Profit margin.
have a profit.
So that is what this profit margin is. That is the profit margin. You have to look into profit margin cannot be such that you cannot say that 20 rupees is the my cost, so I will sell at 40 rupees. You cannot sell at 40 rupees because other people are selling at 25, 26, 23, 24. So nobody will come to
Yes, sir.
buy from you. So profit margin is also such thing which to be calculated in such a way that your rate of interest will be accepted by majority of people. They will come to you. If you say that I will charge 10% in housing loan, who will come to you? If State Bank is giving 6.5% of housing loan, if you charge a 10%, who will come to you? So profit margin should be decided by the bank accordingly. Now is it clear profit margin?
Sir, yes. Sir, kindly adjust capital charge to this example.
What example you want?
Sir, you are
Capital
saying-
charge. I have not started the capital charge calculation. When I start the calculation, then we ask. And you will be totally in a confusion and puzzle how this capital will be calculated. Capital charge means calculation of capital needed. We'll do that for credit risk, we'll do that for market risk, we'll do that for operational risk. 3 different types of calculation of charge capital will be done. So wait for that.
Okay.
You have to wait for that. So capital charge calculation numericals will come definitely. 2 or 3 questions will be there. So be ready for that. I have not started that. You only understand the term capital charge. Okay. So because risk management is, as I told you, it is about how much capital I want. So basic thing, main important thing, risk management is calculation of capital. That calculation is called capital charge. We will come to that for each type of risk when discussed. I will explain those. Lot of numericals are there. So be ready for those things. So pricing is transaction based. Means for each transaction, each individual loan given, pricing has to be decided for that, for which the entire risk management process is done at transaction level. So pricing is very important. So risk pricing is done in that way. Okay. So now risk pricing is done. Next one was risk monitoring and control. That is a simple process. So department are there in the head office. They will be a continuous process. They are monitoring and controlling the entire risk management processes in the bank. Okay. Now 6 was risk mitigation. Risk mitigation means, already I have told you when I given those first slide where all the 5 steps of risk management was given. Risk mitigation means, is there some other extra way or additional way where we can prevent the losses, or we can reduce the risk of loss? Is there anything which is available other than this risk management procedures? So basically risk mitigation means it is a strategy to reduce the loss arising out of adverse nature of uncertainties in our banking business. So basically we can see that risk is divided into 3 categories as per our balance sheet. So loan is where we are most. So that risk is called credit risk. Then our investment is there. Investment is market risk. And apart from this loan investment, everywhere operational risk is there. Everywhere in the liability side as well as loan investment, everywhere operational risk is there. So entire banking risks are categorically divided into 3 major types. That is called credit risk, market risk, and operational risk. Okay. So how to reduce the losses in credit risk? How to reduce the losses or reduce the risk in market risk, and how to reduce the operational risk? Is there any other strategy available? So that is what the risk mitigation is. There are varieties of things available or varieties of financial instrument or different type of techniques are used to mitigate the risk. So basically risk mitigation means we always aim to reduce the loss potential or reduce the downside potential. Okay, so basically how the main in credit risk, what is the mitigation process? What we do already I have discussed. In credit risk, what is the mitigation process each bank does?
Securing collateral security.
Very good. So collateral security. We ask for collateral security because if collateral security is there, to that extent, our risk is to be reduced. If it is fully covered, then you can say that we are risk-free. If a collateral security is more than the loan amount, we can say that risk is almost nil. So to the extent of collateral security available to the bank against any loan, we may have managed to mitigate the risk of credit. Okay. For market risk,
Hedging, sir.
yes, hedging, how it is done? Hedging is the term, but how hedging is done? Any instrument can you name? Hedging is done through what kind of instruments?
Forward booking, sir.
Derivatives.
Forward booking.
Okay. Okay. So basically, we can call those as derivatives.
Derivatives, sir.
Derivatives.
Arbitrage.
Huh?
Arbitrage.
What is arbitrage? Arbitrage is coming in your foreign exchange. Derivatives. Swaps, futures, options, forward contract. All these are hedging instruments to reduce the market risk. Okay. Now for operational risk. For operational risk.
Documentation.
Documentation. In documentation, how you are preventing the risk? You are actually
Proper stamping.
Following rules.
Proper documentation, sir. As per guidelines.
Creating charge on the security.
Creating some.
Maker safer concept.
We are following guidelines, sir.
Operational risk is due to operational risk. Operational risk means
Systems and procedures, sir. Asset liability.
Internal controls. Lack of
Failure of systems and
how you are. See, question is how you are reducing the loss. How you are going to
No any
reduce
clerical mistake, sir. No any clerical mistake.
Oh God. Operational risk can be mitigated through only one procedure. Operational risk is loss due to any other external event or due to the system failure or say computer software failure, everything happens. So how you are going to reduce this thing? How you are going to?
BCP.
Maintain system, sir.
Plan.
BCP.
BCP backup plan, sir.
Backup, sir.
Insurance.
Operational risk mitigation can be done through only insurance, nothing else. You have to insure all the things. System failure, if there is a fire or earthquake or anything happens, so basically part of the operation risk can be covered through insurance. Other thing, what you have told, it will not going to reduce the losses due to, if there is a loss due to somebody has done some fraud, how you are going to, suppose you are sending cash in transit, suppose cash is looted, how you are going to reduce that? If insurance is not there, you tell that I will give my training to the staff. How that training will matter in this case? How the clerical error will matter in this case? How the backup is going to matter in this case? So operational risk only mitigation process is insurance. Okay. So mitigation already. So credit risk we can do it with collaterals as in the form of cash or security or landed properties or guarantees or credit derivatives also. Interest rate or market risk through interest rate swap, forward rate agreements, etc., derivatives also. Then forex risk through forward contract, options or future. Then operational risk is through only insurance. These are the mitigation factors to reduce the different kinds of risk. I hope it is clear. Okay. But apart from this, there is another method to reduce the risk in credit. Credit risk can be also reduced apart from all this I have written. Another thing is available where we can reduce the credit risk also. Or sometimes we can reduce the portfolio risk in the market risk also, investment portfolio also. So how this is done, I will tell you, because sometimes numericals are asked for that. Okay, so we'll go to the next. So that is called mitigation through diversification. Mitigation through diversification. What is diversification?
To divert the risk from one point to another point.
Divert the funds.
Okay, so diversification means
Spreading.
Spreading the risk. That is correct. Okay. So how you are going to spread the risk? So very carefully listen to that so that in any numerical comes, you can do that. Okay. So mitigation through diversification and portfolio risk, how to manage. So this is again standard deviation come into picture. Okay. So here standard deviation we have to calculate the same way we have done in the volatility. Okay. Now suppose somebody has a business which is called business A. So Mr. X is there. Mr. X is having a business A. And these are the last 5 years profit figures. So these are the last 5 years profit figures. So 10, 3, 4, 8, 11. So total is 36. Now we have to calculate what is the standard deviation. Same way, we have to find the mean, then the deviation, then square the deviation, then sum that square of deviation, then find the average by dividing it by n minus 1, then square root of that. So I have calculated that it comes to 3.56. Okay, now another column we have to calculate, which is called standard deviation to mean percentage. So this and this percentage, what is the percentage? Is 3.56 out of 720. So it is basically 49%. So I have taken it 0.49. Is it clear? This line is written. Is it understandable?
Yes, sir.
Yes, sir.
Yes, sir.
So these are the net cash flow or profit. So we observe that the Mr. X cash flow or net cash flow or profits are different in each year. So there is variation in the net cash flow. That indicates when there is a variation in the net cash flow. So what does it mean? I have already explained that if cash flows are varying means what?
There is a variation
in cash flows.
If the net cash flow are constant, those type of business are called
Zero risk.
zero risk or we can call risk free. So when the net cash flow are variable, then we can call that this is not a risk free business. So this business is risky because every year it fluctuates. The profit is fluctuating. And this risk can be measured using the standard deviation to mean percentage. So here we can say that as per this business A is 49% risky. Because of this variation of cash flow, we have arrived at this standard deviation to the mean percentage, which is 49%. So this business is 49% risky for Mr. A. Okay, so if you have understood this, then we will see how the diversification, how Mr. X can diversify his business to lower this risk of 49%. Is it clear? Have you understood this?
Yes, sir.
Okay, fine. So now this is the 49%. Now for diversification, Mr. X, what he does, he starts another 3 or 4 business. He is doing a single business here. He starts another 3 or 4 businesses together. And for all 4 or 5 business what he has started, we can see the 5 years net cash flow. We will find out what is the standard deviation. We will find out what is the standard to mean ratio or mean percentage. So I can say that suppose these are the business A was there where the risk was 49%. Now he has added 4 more businesses, B, C, D, E. 4 businesses. So there are different cash flows are there, different profits are there. So each one I have calculated. So that means business B is 61% risky, business C is 57% risky, business D is 55% risky, business E is 36% risky. So these are the different type of risk level of his business, which is calculated as per the net cash flow of each year through this formula. Now, when we add up all the business together, so total portfolio comes as this 38, 40, 21, 27, 30. So total comes 156, mean is this much, standard deviation this much, and the risk has come down to 25% because he has diversified the business. So earlier one business 49%. Now when he is doing 5 business together, his average risk of all the together consolidated risk becomes 25%, which is considerably lower than 49%. Even you see, out of these 5 business, the lowest risk was 36% and highest was 61%. Still, when you take all things together, his risk level is reduced further from 36% to 25%.
It is just like investment in mutual funds.
Same thing. That is what I am going to explain. So, when you are investing money, bank's investment portfolio or bank's loan portfolio. Do not give loan to one industry. You only give to steel industry. If steel industry fails, entire thing will fail. So you give it to other industry. You have retail loan. You have so many varieties of loan. So that is the diversification. So by diversifying your portfolios, whether it is a loan or investment, whatever it may be, you can reduce your risk. So this is one of the important mitigation process of risk. Clear?
Yes, sir.
So numerical question might be asked for this. So they will give you up to standard deviation. They will give you. They will not give you this column. So they can ask you here, what is the average or consolidated risk for Mr. X when taken together 5 business. So you have to calculate this one and you say it is 25%. And it might be asked that which...
Sir, 0.25%, how did you get total portfolio in the last column 0.25?
Can you read this one?
SD mean percentage.
So what is SD? How much is the SD? For this, what is SD? For total portfolio, what is the SD? Huh?
SD.
What is the SD?
7.8.
I hope you got it.
7.85. What is the mean?
31.20. Question number 4.
multiplied by 100, how much you get?
25%.
So,
Okay, got it, sir.
got it. You are not looking at the heading at all. When I was explaining the first one, I have clearly stated. Here it is, headings are there. If you do not look those things in detail, how can you say understand this? This makes it very good. Be careful. When the risk management is not a JIB type subject. It's very complicated subject. And if you understand the concept, you can score more than 70%. If you do not focus, there is risk. Okay. So diversification, it is clear. There is no problem. Okay. This process is called diversification of risk. Okay.
Sir, on doubt, sir.
What is the doubt?
Sir, how to derivate that 3.56?
What? 3.5?
On the derivation.
Huh?
The next column of mean.
This is standard deviation.
Yeah.
Standard deviation in volatility I have explained. Have you understood that?
Yes, sir.
So that is the way you have to calculate, and I have calculated status. I have skipped two, 3 steps. So I have taken the standard deviation directly.
Okay, sir.
I have given that after mean you have to find the deviation, then square the deviation, add the sum of those square deviation, then take the average by dividing by n-1, then square root. That is the standard deviation. So I have not done those things. I have skipped those steps and I have arrived at the standard deviation. Okay.
In exam, data will be up to total or mean.
Pardon?
In the examination, the data provided shall be up to total or mean.
If it is a 1 mark question, then they will give you standard deviation. If it is a 4 mark question, 2 mark, 2 or 4 question will be there, they will give up to mean. So it depends. Normally it will be given for up to standard deviation, so it will be a 1 mark question asked to you. Can I move to the next one?
Yes, sir.
Sir, yes, sir.
Okay. Now, why this risk-based regulation come into the picture worldwide? What was the reason for that? Why BCPS was formed? So there is a incident behind it. So basically you can read that incident in the book, McConnell book, it is written. So that incident is called Herstatt risk. Herstatt risk incident. So basically Herstatt was a bank in Germany. This incident happened in 26th of June 1974. So basically Herstatt was a bank in Germany who borrowed dollars from American banks. So they borrowed the dollar on Friday. So call money market, they borrowed without any security, it happens. So Monday they are supposed to square it up. They have to pay back. So Friday they have borrowed say 300 or 500 million dollars they have borrowed. And Monday they are supposed to pay it back. But in Monday, German central bank, Bundesbank declared that this bank has totally failed, it is closed. So the banks who had lent this money, 3 or 4 banks who have lent 500 million to Herstatt Bank, think of their situation. They were totally, because there was no security. This call money market, normally for one day, there was no security dealing. So it was given on faith only. So, and there is a time difference between this. So this was a settlement risk. It was not settled. It was, the amount was supposed to be settled on next day, which was not settled. So this was a settlement risk which happened. So now this incident worldwide, it was given a shock to entire financial world. that if we give as a bank, we give to some other bank some money, and next day that bank is closed. The regulator says that this bank is closed, means we are gone with that money. So how can we decide to whom we are going to give money or to whom we should not give the money? Because at that time, no such fundamental benchmark available for any financial institution or bank to look into that bank and say that this bank is a safe bank or healthy bank or not. There was any benchmark was not there. No benchmark was there. So there is no such financial benchmark available for a bank where any other financial or bank can decide whether that bank is a strong bank or weak bank. Because each country in the world, they followed their own rules or arbitrary rules were followed. As regards, say, we can say capital is the main for business. So as regards capitals also, different countries follows different rules. So after this incident, lot of research was done, a historical study was done, research was carried out by the Bank of International Settlement and other financial institutions in USA and UK. And they have come out, finally they came out with, after such of 10 or 15 years, they finally in the 80s, they came out with a solution that there has to be some financial benchmark. And this led to what is called the minimum capital requirement. So they advise that all over the world, bank and financial institution to maintain a minimum capital which should be based on the risk weight assets. Their assets are earning, so what is the risk that assets are carrying? According to that, certain percentage of the risk weight asset has to be maintained as the minimum capital. So if a bank is maintaining that minimum capital, we can assume that this bank is healthy. It is not a weak bank. So this Herstatt risk is actually the incident which led to the introduction of this minimum capital requirement. So in 1992, finally this PCBS was formed, and they suggested this minimum capital requirement framework, and they suggested that minimum capital requirement should be 8% for credit risk only. When it was started in 1992, they told that only credit portfolio, they thought that only risk is there in credit. So they told that each bank is supposed to maintain 8% of credit risk weight asset. Because at that time they thought that there is only risk available in credit. Other things they do not have gone into them. Okay, so gradually, when the banking advanced, technology included everything else, so again BCBS and the Bank of Internal Settlement, they suggested that apart from credit risk also, since we are investing in some security, everything, so there is also investment risk, or we can call that market risk. Market risk is available. Afterwards, again, it was found that no, in the liability side also deposit frauds happening and so many losses happening due to system failure, earthquakes or natural disaster. So finally, operational risk came into picture. So three major risks were evolved during this process. So basically, Basel I Accord was carried out in 1988, where the minimum capital requirement was suggested for credit. Then Basel II, in 1996, market risk was introduced. Since They thought that investment portfolio also banks are losing. So we have to start the market risk process also. Then Basel II was introduced in the year 2008 and 9, where the operational risk was included apart from credit and market risk. And the earlier Basel I was there, so it was revised with some stronger norms, stronger rules and regulation in Basel II. Then finally Basel III has come in 2013, where all the three risks are there, but it has got more stringent guidelines for maintenance of capital. What type of capital do we maintain? How much do we maintain? So the rules are becoming tougher and tougher. And it was supposed to completed in India by 2019, but till now we have not complied with all the Basel III guidelines. In between, pandemic happened. So there will be delay. After the completion of our compliance, Basel IV will be coming. Basel IV is almost ready. So as the day progresses, the guidelines are becoming harder and harder or severe. Okay, so these are the basic things which is behind the formation of Basel Committee on the Banking Supervision or BCBS under the patronage of Bank of International Settlement and the G10 country. They are the pioneer in bringing out this Basel Accord. And this has helped the entire banking and financial industry. Now we can see that rarely some banks are failing. Very small banks are failing. Okay? Okay, this much is for today. Any questions there, you can ask me. Otherwise, we'll end up here today.
Sir? Sir, actually, whatever slide you taught today, can we get today? Actually, we have to revise, sir.
Revise, I am going as per the Macmillan book. You read the Macmillan book, I am going sequence wise. Entire thing is given with explanation in the Macmillan book. It will be very clear to understand. And I have already told you, I am telling again, that when we complete the risk management module, I will give this PPT, not before that. For the last 6-7 years, I am following my principle. I am doing that only because if I give this, you will not read the Macmillan book or study material. You will always refer to the PPT, where PPT is only headlines. The actual news in the book is there. And book, if you read the book, I guarantee you that it will be very, very helpful to you, rather than just following the PPT.
Sir, actually, sir, I was reading the book as per the it told, but sir, there are 2 chapters have been left by you. Basel chapter and one chapter and one more chapter. You left and you go to the market directly.
Which one you are talking about? Tell me. Which chapter?
The chapter number is 10.
What is that?
Risk regulation banking industry.
Risk regulation banking industry. What are those things available there? You tell me. Any points you can just tell me.
Yeah, Basel I Accord and capital regulation in India.
So that will come. That is not because fundamental thing is that is again repeated afterwards. Same thing will be repeated afterwards. That will come. All the things will come. I will not leave anything. If you read it, it is revision has been done. So well, I will be explaining. It will be easier for you to understand.
Sir, you also told that told that tier 1 and tier 2 capital.
I have not started those things. Why you are, see, there are still 40 slides are there.
Right, sir, right. Thank you, sir.
After I complete the module, you tell me whether I have left something, and in turn I will ask you how much you have understood something. If you have understood 90%, then I will say that yes, I have left or not. If you have not understood 90%, then don't ask me the question. Because things have not come. I am just at the door now. I have not entered the door of risk management. What is capital? What is tier 1 capital, tier 2 capital? How they are tier 1 capital, two types. What are the elements of capital? What are the different types of credit risk? How these are calculated? Everything is there.
Yomi, anything.
Sir, I would like to see the questions what you have explained in these slides today.
What?
I would like to see the questions one. Whatever you have explained.
Question, you want to see the slides?
Yeah.
This was one.
Yes.
You are taking screenshot?
Yeah, I would like to take the screenshot, please, if you don't mind.
Do it fast. Do it fast. I don't have time. Do it fast.
Sir,
Yeah, I have taken this one.
Okay.
sir, in where questions will not be there, sir, calculating total portfolio value, percentage.
It will be there. Question will come.
This one done, sir. This is also done.
Here also, at the bottom, one question is there.
Yes, sir, here.
Yeah, taken.
Sir,
Here
actually I
in
could
the
not take.
bottom, one question is there. Just 1 minute. Let her take the screenshot, then we'll then ask.
Yeah, taken, sir. Taken.
Sir, actually,
1 minute. 1 minute. This also you take.
Yeah, taken.
Okay, that's all for today.
Thank you so
That
much,
was the
sir.
thing. Okay, ask me what you want.
sir, actually, first slide I could not take a screenshot. Second, please, I want to see that. First slide, sir.
First slide was this slide only. First
No,
was
numerical, sir. You first saw me. Sorry.
this one.
No, this one not.
Then this one. This was the first slide of today. This was the first slide.
No, sir. Actually,
This is the next slide.
the first one which Madam told you to show. Madam told you, no, sir.
Last one, sir. Standard deviation to mean.
Yes.
Last one is the fast. How that will be fast? This one.
Yeah. Yes, sir.
This is the last one. First one is volatility. I started at the first one is that one.
Okay, yes. Okay, sir. Sir, in Bigyan app, is there any password or ID required, sir, if you download from Play Store?
The download for what?
Bigyan app you told today. The Bigyan app, there are a lot of questions, numericals there.
First thing is that it is provided to the students who have totally paid their fees. Have you paid the fees, entire total cost of the CIB you have paid?
No, sir.
So if you have not paid to some people, they have given a ID and password. If they are not paying within 30th September, they will be blocked from it. So they cannot access those things. So first thing is that you should pay them out the full. Then they will provide this email and the ID password where you can access all the things, whatever the subject you are appearing for. If you are appearing for BFM and ABM together, so accordingly, BFM and ABM thing will be given access to you, where all there are thousands of MCQs as well as numericals. Series in the BFM, there might be more than 400 numericals are there, 400 or 500 numericals are there. ABM also, there are certain numericals are there. So you can access those things and do all those things, and those are totally computerized, as if you are appearing in the examination. So you can access that one, do your thing, and see what is the performance. If somewhere you are not getting the numerical solved, take that question, ask in the WhatsApp group, faculty will be there, they will be explaining those things.
Okay, sir. Thank you, sir. Okay, sir.
Thank you, sir.
Okay, good night. See you tomorrow.
Good night, sir.
Good evening, sir.
Good evening.
Good evening, sir.
Good evening.